Hello, this is Prof. Aram, and in this video I'm going to explain this DuPont analysis, which is arguably one of the most important things that we can do in our ratio analysis practice. So let's get to this. Of all the ratios that we looked at so far, arguably the most important one is the return on equity, right? Because going back to the original concepts that we looked at, the goal of the firm is to maximizing shareholder wealth. So you want to be able to measure the return to the equity holders of the company. So I argue that the most important ratio so far that we looked at is the ROE because it is in line with the goal of the firm. And it is also widely used, and it is important to understand the factors that contribute to the growth of ROE. So DuPont Corporation came up with this idea of decomposing ROE to find out what is the driving factor for ROE. So we are going to basically decompose ROE to a profitability factor, a productivity factor, and a capital structure or leverage factor. So we are going to look at profit margin, asset turnover, and leverage ratios. If we simplify these by eliminating assets and sales, you end up with net profits over shareholders' equity, which is the formula or the ratio for ROE. So profitability is the most important contributor to ROE because like this profit margin shows for every dollar of sales how much net profit is earned. Productivity shows how efficiently assets are used to generate sales. And leverage, as we mentioned before, can magnify the returns, which in this case we are looking at the ROE, can leverage magnify return to shareholders' equity. ROEs might be similar among companies, but the components of the ROE can be significantly different from each other for these firms. So using this formula allows us to discover the source of a high ROE or discover the source of a low ROE for that matter. So let's look at an example. What we have here is the DuPont analysis for Timberland Company in 1994. Here, if you were the manager of Timberland in 1994, what number are you going to focus on? You look at these numbers and try to tell a story by comparing Timberland with the industry. So if you're the manager, what number would you emphasize on? Of course, you would emphasize on the ROE. Return on equity for Timberland in 1994 was 11.9% and the industry median was 12.3%. So it's not far off from the industry median. So you can argue that you're very close to the industry median. So if you're the CEO, you should emphasize on the ROE because it's very close to the industry median. And you can argue that the firm is doing fairly good because you're very close to the industry median. But would you agree with that? Where is this high ROE coming from? Is it from profitability, productivity, or leverage? When we do this DuPont analysis, a different picture will emerge. Then we'll see the distortions from the company's measures and the industry median. As you can see, the return on invested capital is significantly less than the industry median. The profit margins are lower. So obviously the ROE is not driven by the profitability. The asset turnover is also lower. Inventory turnover is lower. Collection period is significantly higher. The median firm in the industry collects cash within 40 days, but Timberland is collecting in 73 days. So it takes them almost twice as long to collect cash from the customers. And the payable period is less than the industry average, which is not as bad, but it's not good either. Because the average firm in the industry pays the supplier in 36 days, but you have to pay them in 32 days. So the suppliers demand you to pay faster than the median firm in the industry. So it's not from the turnover or productivity ratios as well. But you see that the firm has more debt. So the asset to equity ratio is higher. Debt to asset ratio is 68% compared to 40%. So almost 30% more debt than the median firm in the industry. Times interest earned is 1/3 of the median firm in the industry. So the firm is walking a financial tightrope that other companies try to avoid. And of course, the current ratio is higher, but we'll see why it's higher, because they have too much inventory in hand and they can't get rid of the inventory. So the current ratio is higher. In fact, if you calculate the quick ratio, that should be significantly lower than the industry median. So even though the return on equity is close to industry median, but we see that this ROE is not driven by the productivity or profitability, but it's driven by the leverage, high leverage in this firm. In 1995, the picture turns really bad for the company. So they're going from 12% ROE to a loss of 8.2% for the shareholders. So now you see the problems are coming to surface for this company. Timberland is losing 8% for shareholders, whereas the median firm has a return of 12.3%, which obviously, as you can see, this is driven by low profitability. Gross profit margin has gone down too. The asset turnover ratio is also lower than the median firm in the industry. The inventory turnover has increased actually. Why do you think inventory turnover has increased? If you're a firm in financial trouble and you want to get rid of the inventory, you might have discounts, you might have sales, right? 20% off, 30% off, 50% off. So they get rid of inventory, but they're not getting the full price. That's why the inventory turnover has increased, but you're still losing money. Average collection period has gone down either, meaning that you are collecting cash faster. But why doesn't it show in the profitability? Why doesn't it show in the ROE? Because usually, again, if you're a firm in need of cash, you may sell your accounts receivable to third parties for, 80 cents per dollar. So you can get rid of the accounts receivable and collect cash faster, but at a significant discount. Payable period has gone even more down. It's even shorter than before, meaning that in this situation, suppliers are smelling trouble. They see that the company is in a bad shape, so they are demanding to be paid faster. So the average pay period is gone down from 32 days to 21 days. Profitability ratios don't look good. Turnover ratios don't look good either. What about leverage? You still have a very high leverage compared to the industry median. But now, because of the troubles in terms of profitability and productivity, you're very close to bankruptcy. Your times interest earned is 0.2. It's very close to zero. Actually, no. In this case, you have to file for bankruptcy because your EBIT is not even enough to pay the interest expense. So the company is in a really bad shape when you look at the DuPont Analysis of the firm. Finally, they turn it around and make a change in the company. Basically, they move from a family-run company and they hire professional CEOs to run the company, right? And then they turn things around. So from 1995 to 1996, now the ROE is comparable to the industry median. They are actually increasing the return on invested capital and profit margins. So they look much better than the previous years. And the turnover ratios all look good. Now they're improving on the time interest earned. Right? Keeps increasing. In fact, in the most recent year, 1998, is even higher than the industry median. They're lowering the amount of debt that they have. So the things that happened here was, again, professional management helped the company, and Timberland became the chosen brand of hip-hop artists in the 1990s, which helped the popularity of the brand during that period and turned things around. So it led to a remarkable improvement in the performance of the company. So the whole point of this practice was to look at the drivers of ROE. Right? Again, you might have 3 different companies with the same ROE, but the drivers of ROE for these companies can be totally different. What you want to see in the ROE is your ROE being driven by profitability and turnover ratios. In other words, you want the ROE to be driven by the core business of the company, not by your leverage or how innovative your capital structure or your leverage is. You want it to be driven by the core business or by your operations of the firm. I hope you find this video useful, and thanks for watching.